Welcome to the Pro Ticker Deep Dive. We are jumping straight into orbit today because, well, the space industry is going through this.
hmm
This unprecedented structural pivot. We're watching the entire sector shift from being the exclusive, expensive domain of governments
Right.
to a commercial powerhouse where proven operational excellence is, well, it's king.
It's an undeniable structural transformation.
Yeah.
I mean, the numbers completely bear it out. The global space economy has already crossed $600 billion.
Wow.
And our mission today is really to unpack the story of the 2025 space stock rally.
Yeah.
It was defined by this massive divergence among the key players. And that divergence, it tells us exactly what the market is willing to pay for and what it's punishing right now.
And the big question we're asking you to consider is this. As infrastructure goes orbital, what if the space industry is becoming as essential to a diversified portfolio as, say, high-growth tech stocks were 2 decades ago? The potential is just massive, but the volatility is extreme.
Oh, you see that volatility so clearly in the performance snapshot from 2025. On one side, you have these reliability and conviction plays. You've got Rocket Lab surging 58% and AST SpaceMobile absolutely soaring with a 134% gain.
134%.
Yeah. And that's a pure high conviction bet on a massive technological leap.
But then you have the reality check. Intuitive machines. I mean, despite having achieved that landmark lunar landing in 2024, it stumbled hard. It's down 58% year to date. That incredible difference from a triple-digit gain to a near wipeout, that's the story we need to unpack. The market is rewarding immediate operational results and punishing uncertainty and execution challenges fiercely.
To understand the divergence, we have to look at the macro backdrop.
Yeah.
It's what's driving this whole renaissance. We are in, a golden age of commercial space, and it's powered by 3 converging forces that have utterly changed the economics of getting to orbit.
Okay, so the first force is fundamentally technological, right? Reusable rocket tech.
Yeah.
When you can reliably land and relaunch your primary stages, you dramatically slash your input costs.
You do. And this tech has reduced the cost of access to orbit by a factor of 10 over the last 2 decades.
A factor of 10.
10. And that single change has opened the door for thousands of new entrants.
Okay, so that's force number 1. What's number 2?
The second force is the economic pull. It's the exponential demand for satellite-based connectivity. And this isn't just about faster broadband in cities. We are talking about creating a digital infrastructure layer for billions of underserved users globally. The economic incentive is just massive.
And the third force, which this feels like maybe the most significant structural change, is capital allocation.
Yes.
For the first time in just the last few years, private funding has finally eclipsed public spending. This means the industry is no longer dependent on government timelines. It's driven by, venture capital expectations and commercial profit motives. That is the clearest sign of commercial maturity.
Let's put some hard data behind that. In 2024, the global space economy hit $613 billion. That's 7.8% year-over-year growth.
Go.
And here is the crucial metric. The commercial sector now accounts for 78% of that total. It's a commercial enterprise, first and foremost.
78%. That's stunning. And the projections suggest we're still in the early innings, right?
Very early. I mean, conservative estimates project the space economy could hit $1 trillion by 2032.
A trillion.
That's a 9% compound annual growth rate, or CAGR. So steady, strong growth. Broader, more optimistic forecasts suggest it could even reach $1.8 trillion by 2035.
So while commercial space is defining most of the activity, we probably shouldn't ignore the foundational role of governments.
Oh, absolutely not. Government spending provides high margin demand and a lot of stability. The U.S. alone allocated $77 billion to space spending in 2024. That's across defense and civil agencies like NASA.
And that government spending, it drives key commercial programs. I mean, look at Artemis, NASA's return to the moon. It creates guaranteed commercial demand for everything from landers to cargo services. It ensures that strategic imperative for, assured access to orbit is always there. It's a stable backbone of contracts for the whole industry.
So if the structural shift is the engine, then connectivity is absolutely the fuel.
It really is the core accelerator.
Yeah.
To put the scale of this opportunity into context for you, about 5 billion people globally have mobile subscriptions. That sounds like almost everyone.
It does, but it's not.
But nearly 3 billion people remain effectively disconnected. They're in remote rural areas, developing nations that lack fiber, or they work in maritime regions. That represents an enormous untapped market.
And that is precisely where the low Earth orbit, or LEO solution, is so essential. LEO satellite constellations, they bypass the incredibly expensive and slow process of laying terrestrial infrastructure. They are designed to deliver gigabit-class connectivity directly to devices. This is what changes the global digital landscape.
This ambition is driving an infrastructure build-out that is it's unprecedented. In the first half of 2025 alone, we saw 149 orbital launches.
Yeah, think about that.
That's one launch every 28 hours. It makes you realize how routine yet relentless space access has become.
And it's the satellite internet providers that are leading these deployments. Starlink, with its sheer volume, I think it's over 8,300 satellites in orbit. As of mid-2025, it currently dominates.
Of course. But the market's just too vast for a single player to capture, right?
Way too big.
So who else is in the race? You've got Amazon's Kuiper, which is targeting government and enterprise clients with a more structured approach.
And then you have the combined entities like OneWeb and Eutelsat, which are focused on merging satellite capacity with, traditional telecom infrastructure. The competitive battle is happening like 300 miles above our heads right now.
Okay, let's drill down into that divergence we talked about, starting with the poster child for success in this environment, Rocket Lab.
This is the operational efficiency play. This is where reliability has directly translated into market success.
The specifics of Rocket Lab RKLB are pretty impressive. They operate the world's most frequently launched small orbital rocket, the Electron. It's the workhorse of the industry.
It is.
In 2025, they clocked 18 launches with a perfect 100% mission success rate.
And what's truly revolutionary is the operational throughput. They completed back-to-back launches from launch complexes on separate continents.
Right, one in New Zealand, one in the U.S.
Within 48 hours. This capability fundamentally changes logistics for satellite operators. It means they can offer rapid deployment and responsiveness that competitors just can't match. Especially useful for, crucial government or military clients.
And financially, that efficiency is translating. Q3 2025 revenue hit $155 million, up 48% year over year.
And even more critical, they achieved record gross margins of 37%. For a manufacturing and launch company, that kind of margin expansion, it signals superior cost management and scalability.
They also exited the quarter with a robust $1.1 billion backlog.
So the bull case, which is reflected in that 58% stock rally, is built on consistency and a really clear roadmap. They have a defensible niche as the leading small launch provider. And crucially, they are developing Neutron, a medium-lift vehicle, that's scheduled for Q1 2026.
So why is Neutron so important?
Well, medium-lift vehicles can carry larger satellites and, crucially, deploy entire constellation batches in a single launch.
Oh, okay.
These missions inherently command higher margins than the smaller Electron missions. So if Neutron executes, it unlocks a massive, higher revenue customer base and strongly reinforces their path to being cash flow positive by 2026.
But let's look at the risk. A 48.5 times sales valuation is incredibly rich.
It is. The stock's performance in 2025, it wasn't a steady climb. It had a pretty significant pullback. The primary risk is execution on Neutron. Any delay could derail market confidence.
And competition?
Well, while they dominate the small lift market, competition from established giants like SpaceX and, increasingly capable state-backed Chinese providers is always intensifying. It threatens their pricing power.
Okay, so that's the efficiency story. Now, let's pivot to the high-wire act, the pure risk-reward scenario in this sector. AST SpaceMobile. This is the ultimate high beta play. It reflects all the hope attached to one specific technological achievement.
Right. ASTS is this massive bet on satellite-to-cellular technology that promised to deliver connectivity directly to standard, unmodified smartphones.
No dish, no special case?
No, just your everyday device getting service from space.
The validation milestones are huge. They successfully demonstrated direct voice and video calls from space. They've secured partnerships with heavy hitters like Verizon, Vodafone, and Saudi Telecom.
And these are multi-billion-dollar commitments, pending execution.
But here is the tension that defines the stock. In Q3 2025, they missed revenue consensus dramatically. They reported only $14.7 million versus a forecast of almost $22 million. The EPS miss was steep.
Right.
And yet the stock rallied 3.3% after hours. Isn't rewarding a steep revenue miss a classic sign of, market irrationality? Or is the market just trading on the Verizon contract and ignoring the current reality?
It's the latter. The market sees zero commercial revenue today, but it is entirely focused on the total addressable market, the TAM, and the unique proposition. The stock is a futures contract on deployment, not current earnings.
Okay.
However, executing that future is incredibly capital intensive.
And we see that in the cash burn.
Oh yeah. The capital expenditure run rate is significant. It hit $259 million in Q3 alone, mainly for manufacturing the next generation of satellites. They successfully raised $1.6 billion, which gives them roughly 2 years of runway to get the constellation up. They need 45 to 60 of their Block 2 Bluebird satellites in orbit by 2026 to start offering meaningful commercial service.
So the bull case hinges entirely on that deployment schedule. Commercial service is slated for late 2025, early 2026. The Verizon partnership alone is viewed as a multi-billion-dollar revenue stream.
The bear case, however, is just as compelling.
Yeah.
Because everything is contingent on meeting that launch schedule and getting regulatory approval.
Wow.
If launches slip by 6 months, they could face a severe funding crisis.
And the competition is escalating. SpaceX's Starlink is already live with T-Mobile, and they just acquired EchoStar's crucial wireless spectrum.
That spectrum acquisition is a massive threat, isn't it?
It is. It fundamentally changes the competitive landscape. Acquiring that spectrum gives Starlink a huge regulatory and technical advantage. It lets them bypass some hurdles and directly compete with ASTS's core offering.
It elevates the risk significantly. So that 134% stock rally reflected immense hope, but the underlying risks of zero current revenue and intense competition. It just means it remains a very high-stakes gamble.
Okay, let's turn to our third case study, Intuitive Machines. This is the execution challenge story, the company that bet big on the moon and had a mixed flight record.
They started with success. The IM-1 mission in February 2024 was a monumental achievement, the first commercial company to land on the moon. That provided incredible validation. But execution risk materialized with IM-2, which launched a year later in February 2025.
That mission failed.
Precisely. IM-2 landed on its side in a crater, and that severely limited its power generation and mission duration. The stock crashed 24% on that news. It just shows the market's extreme sensitivity to execution failure, especially for a pure-play lunar company.
So how do you mitigate that kind of risk? Well, they deployed a serious trump card. This transformative acquisition of Lanteris Space Systems for $800 million.
This is the pivot. The CEO explicitly said that this marks the transition from being solely a lunar company to becoming a multi-domain space prime.
A space prime, what does that actually mean for them?
In industry jargon, it means a major contractor that can execute complex, large-scale programs across various orbits and domains. It diversifies them instantly.
Okay, so it pulls them away from just being the moon company.
Exactly. The combined entity projects over $850 million in annual revenue and inherits a massive $920 million backlog. They move beyond the risk of repeated lunar missions and now compete across LEO, MEO, GEO, and deep space missions.
We should quickly explain that LEO is low Earth orbit, which we've discussed, but MEO and GEO.
Right, so MEO is medium Earth orbit, typically used for navigation and specific communication satellites.
Yeah.
And GEO is geostationary Earth orbit, where satellites appear stationary above the same point on Earth.
And that.
By encompassing all three, the new entity reduces its dependency on any single government program or any single mission type.
Wall Street consensus remains moderate buy, which suggests there's some faith in management's ability to execute this strategy.
Yes, the bull case rests entirely on successful integration. They're inheriting a proven spacecraft manufacturer, and they gained essential earnings visibility.
But an $800 million acquisition involves substantial integration risk. That's the new uncertainty the market is pricing in.
You're betting on management's ability to smoothly merge cultures, technologies, back-office functions, all while managing the technical execution risk we saw with IM-2. That's why the stock is down 58%. It's a bet on a very complex turnaround.
So let's synthesize this for you. We've seen three fundamentally distinct profiles emerge from this 2025 divergence, all attempting to seize a piece of that $600 billion space economy.
Correct. If you are looking for the most balanced risk-reward profile, that is Rocket Lab. They are operationally mature, highly efficient, and they offer a defensible entry point into the launch market with a clear path to profitability. They offer reliability.
And if you're looking for that pure high beta, higher reward speculative play, it's AST SpaceMobile. If satellite to cellular commercializes, the reward is massive, but the current reality is zero commercial revenue and intense cash burn. It's a pure play bet on future market dominance.
And finally, intuitive machines is a gamble for the patient, contrarian investor. It's a bet on management's ability to execute a transformative, complex acquisition, transitioning them from lunar dependency to a successful, diversified space prime that can weather setbacks.
The space frontier is clearly open, but the market is becoming highly discerning. It's rewarding proven execution and penalizing speculative risk unless the potential payoff is truly immense. The question isn't whether to board the rocket, it's which vehicle you trust with your capital.
Absolutely. And as these mega constellations accelerate their deployment, they are creating a serious side effect, orbital debris and increasing space congestion. Given that this is an emerging quantifiable risk to operational assets, partially driven by these very companies, what role might future regulation play in shaping the profitability and competitive landscape for the three companies we just discussed? It's something to mull on as the decade progresses.
See you all in the next ProTicker Deep Dive.